Concerns around a possible global trade war continued in July, with tension between the US and China remaining strained as the two countries' tit-for-tat trade spat weighed heavily on emerging markets, including South Africa. The local bourse ended July slightly negative, with the all-share index closing 30 basis points down, with the measure now down 3.5% year-to-date. Tencent fell more than 9% month-on-month, now down 25% from its peak in January, on the back of pressure from a global tech stocks rout as investors price in lower expectations for the company's results due out in mid-August. We point out, however, that Tencent is now the cheapest it has been in over 5 years, on a forward earnings multiple of just 29, against an earnings growth profile of over 35% over the next few years. Financial counters were the performers of the month, up 6.4%, while industrials closed down 2.3% and resource counters were down 1.4%. On the macro front, we saw mixed results. Retail sales grew just 1.9% year-on-year, the slowest pace of gains since July 2017. However, private sector credit extension came in at 5.7%, higher than expected, and CPI came in lower than expected at 4.6%. The Reserve Bank, at its July meeting, held the repo rate at 6.5% and reduced its growth outlook to 1.2%, down from 1.7%. The governor has flagged a possible tariff war and higher global oil prices as the primary risks to inflation. On the currency front, the rand showed some resilience in July, strengthening 3.3% against the dollar, on the back of an improved global risk appetite and news of a loan from China to assist Eskom. On the political front, Cyril Ramaphosa has now racked up commitments of $35 billion in FDI against his target of $100 billion. However, we believe the ANC's decision to amend the constitution to facilitate land expropriation without compensation will weigh on foreign investor sentiment towards the country for some time.